Good day, fellow investors. The ECB cut interest rates, raised inflation forecasts, and that is a huge deal. Just yesterday, I'm filming this on Friday, you'll probably watch this over the weekend, but we have the news, the first rate cut, so the ECB has pulled the trigger because they see inflation going down a little bit, but a little bit higher than expected. So the news is here, they have cut by 25 basis points, moving off record highs, which was 4%. They have increased inflation forecasts for 2024-2025, and they have just not immediately targeted the 2%, but they say 2.5%, 2.2%, and 1.9%. And I have watched the press conference, watched the questions. You have to watch these things, and then you will start thinking about who is in control of our financial existence here in Europe. You must watch the next or this one. It is on YouTube, on the ECB page. You can watch it and you can just feel the sensations of their vague answers to questions, and everything is data-driven, which means nobody knows. That's the key to understand. And then the first question was straightforward. Why cut rates when raising the inflation forecast? Lagarde says because confidence in the path ahead had been increasing in recent months. She's always smiling, very polite, very good. But more on this question, she says, why the increase on confidence? Well, phase one, when they started tightening, they lowered inflation from 10.6 to 5.2, now is 2.6, as they were holding the tightening since October 2022, and then she says that the projections for Q4 2025 for inflation are around 1.9, 2.1, which suggests robustness. 2025 Q4, she's talking about robustness. That is something that I cannot grasp my head around, because the truth is that nobody knows where will inflation, deflation, stagflation, whatever levels be in 2025. Nobody knows, nobody can predict. If she could, or the ECB could predict, that would be the richest traders in the world, and they would not have a job here for the ECB salary. That's how it works. So we as investors must understand that these are just economists like us playing with data and making financial investment decisions based on past data and those trend estimates. So it was 10, it was 5, 2.6, and now it will slowly go to 2.0 because we think so. They never thought it would go up to 10, they never thought it would be 5%, so that's something to just keep in mind. But the key reason why rates have been already lowered is economic nature, because rates of 4% for the European Union are simply too high to justify the current existence of the financial system. Because if you look at this, Italy, national debt, $3.8 trillion, constantly growing, and when Italy, with 144.8% of debt to GDP, has to deal with interest rate payments, this is the Italy 5-year bond, there is a huge difference with that debt being at 3.4% or at 0%. So it was expected that the ECB will lower rates, and that has already been priced in. So they had to lower rates because if interest rates stay higher for longer, Italy and everything else in the economy, the European economy, changes. For example, just to show you, this is Mercedes-Benz Group. If you look at this, they have long-term debt, and there is the finance division debt that is 54 billion plus the 13 plus the 39 of current. I get to more than 100 billion in liabilities. What's the deal here? When they sell you a car, they also finance that car for you. So everything is on a pyramid of debt. And even Mercedes, jobs, holidays, spending, everything is connected to that interest rate. And now they have kept the interest rate high for a year and a half, and now they're already lowering, no matter economic data or whatever, because they know that at 4%, the financial system is at risk of collapsing. She cannot say that, but I think she knows that. I hope she knows that. And then you can see here the financial flexibility, and you can see how much money they have to refinance over the next 12 months, and that's simply huge amounts of money to be refinanced, and that is a huge difference whether it is at 2% if everyone expects rates to go down, or at 4%. But again, just a little bit of rates at 4% from the ECB. Look at the growth rates in the euro area. This is close to zero, likely a bit of financial engineering to keep it. Okay, we are not in a recession, but if you look at this year-over-year data, okay, this is not economic growth. 0.4, 0.5%, closer to 0% in 2023. 2023 was still spending from the pandemic, exuberance, traveling. All the Germans came to Croatia 6 times a year. And now everything is a little bit softer, still good, but not as it was in 2023. And the key is that at 4%, Europe is in a heavy recession with 4% longer rates. Because for the past, Europe has been enjoying a decade and more of 0 to 1 interest rates. Italy was borrowing a negative interest rate. So the whole financial system is made for low interest rates, and you need to refinance this. You need to refinance all those cars. You want to buy a new car, and everything is related to that. So the conclusion is that 4% for a while was the max. If not, it leads to a recession. Despite inflation still at 2.5%, even higher in some countries, they must cut. There is no taming of inflation without severe recession. Okay, they cut, and now we will see whether inflation will creep up. There is so much short-term financial movements, pension funds money coming into the market, chasing those bonds yields that are not existent. Because if I look at pension fund assets in the euro area, 1 trillion, about 30% of the 3-something trillion, and then if that is invested in Germany 10-year treasuries with 2.5% inflation, the real return is 0%. So my fellow Europeans, 30% of your pension assets will not increase your purchasing power in the future. Not to mention that equity is extremely expensive now. Thus, this is the issue that will arise somewhere down the road. I hope the latter the better, because I like those Germans, even if they drive crazily slow with their campers on the highway and create chaos situations. They bring that enjoyment, relaxation of holidays, but that might change in the next 10-20 years because the financial system is unsustainable. Whenever outside forces start impacting it, inflation, commodity prices rising, they will need to print more to finance the debt, and then you have, again, a spiral of inflation like we had in 2022. I hope it doesn't happen yet, but these are the fundamentals of the system. The fundamentals are that we are in for financially engineered lower rates, maybe some growth, but when the next crisis hits, it will be very, very ugly. It's impossible to be smart. I can tell you I don't know where rates will go, where inflation will go. They know. I don't. I know they don't. But as investors, we need to look for value. We have to understand that our pension funds in Europe will not lead to increased purchasing power in the future because it's politically manipulated. They buy what they have to buy. They don't look at price at what they're buying. So if you're a European, okay, enjoy the party while it lasts. If rates go down, again, take a mortgage with fixed interest for 40 years. Thank you, ECB. For the rest, take care of your own financial future. Thanks for watching. I'll see you in the next video.